Welcome back. A House Financial Services Subcommittee holding a hearing on the state of the bond insurance industry. New York State Insurance Department Superintendent Eric Dinallo joins us now live from Capitol Hill and another first on CNBC. Mr. Dinallo, good to have you on the program. Welcome.
It's good to be here. I can hear you. Go ahead, please.
Okay, let me kick it off with reports right now that you are considering splitting up the bond insurers into two businesses. Can you elaborate on this plan?
I think that what I'm going to say today in the testimony, what was submitted in the written testimony, is that's always been an option. Obviously, we would prefer not to have that option, but if the ratings for all the municipal books are at jeopardy, obviously there is an option to permit the insurance companies to file such a plan. We would consider such a plan, and it is something that, of course, we would consider. It's something that I've been considering the whole time. It's not just the possibility for capital infusion. It is the possibility for some kind of a good book or stressed book if there's no other option versus having the entire municipal book downgraded.
Eric, what assumptions are you working with right now? And what I mean is, are you assuming that there will be downgrades for these businesses? We already obviously saw Fidget downgraded today. Are you looking at the future for these businesses as something that has already been downgraded, even though it hasn't been, or are you trying to cut a deal to prevent a downgrade?
No, I think I'm an optimist on this. I think the point of seeking infusions of capital is to keep the rating at AAA. I think it's a good thing to have for our industry to have a AAA rating, and I think that it's not the case that it's a foregone conclusion at all. I think progress is being made. There are serious discussions going on, and the whole point of holding the meetings with the banks and talking to potential investors and talking to fellow regulators is to see if there is something where we can preserve the ratings of the companies. And I think that that's different, by the way. It's a different issue than the solvency of the companies versus their claims paying ability. Obviously, AAA would be the best thing for everyone, and that's what I've been seeking.
So how would you characterize the business today then, Mr. Dinallo? So much worried that these companies are on the brink of bankruptcy, if not going out of business altogether. Earlier on CNBC, the CEO of AMBAC came on defending his business. Give me your gut in terms of where these businesses stand today.
Yeah, I think there's a real distinction between claims paying ability, which concerns us for solvency and the ability to make the claims, and the AAA rating that the rating agencies put on these companies. A company could go into runoff. It could be split into a good book and a stress book, and you would have potentially very robust claims paying ability, but it would no longer have the AAA rating and would be bringing down everything that it had insured, and that's my concern. That's why I held the meeting. Was not so much a concern about the ultimate solvency of the companies or the claims paying ability, but here obviously parts of the economy, the municipal book, and the CDSs and the CDOs have been linked to the rating of the company, and that's why we're endeavoring to try to infuse capital or find other options that you've been talking about for the last couple of weeks.
How much money from one source or another in aggregate do you believe is necessary in order to get done what you want to get done?
I don't want to comment on that. I will confirm that when I talked to the banks, it was an accurate report that I said that across the 3 or 4 companies at that time, it looked like a $5 billion infusion, and I had proposed one option was a $10 billion letter of credit. I didn't say a bailout or a capital infusion of $10 billion. I said a letter of credit, because my thinking was that at worst case, if the economy slid further, that's the kind of letter of credit we could potentially be looking at. But at that time, I said it looked like $5 billion. I think it was across the 3 companies. I'm not exactly sure at this time, but it was more of that kind of a magnitude with a $10 billion backstopped rights offering potentially, or a letter of credit.
Let me ask you about accountability here, Mr. Dinallo. What about the role of regulators, your office included? Have you and your counterparts been amiss in terms of regulating this or overseeing this, missing something that now we are picking up the pieces today?
Well, I don't know. I don't think so. I think what we are supposed to be regulating at the New York State Insurance Department and as an insurance regulator is the solvency of the companies. The question is, do they have claims paying ability? And I think they certainly do. And actually, I think we've done a very good job on that. The question is, and one that I'll tell Congress today is, this is the one insurance area where the rating is also laced into what it does as a business. So I guess the only thing I could say that we might do better going forward is be more concerned, as well as claims paying ability, with what I would call regulating to the rating. That's never been the case. I've been working on it since I took to the job. As I said, I came into the office, but historically and statutorily, it is not the question what the rating is. It's the question whether the company has claims paying ability. But I think that's something that we'll need to take into account in the monoline industry, which is very unique on this question.
Regardless of what the solution ends up being, what is your degree of confidence that when this is all said and done, we will have a healthy, functioning securities market to provide capital into the residential housing market, into the commercial housing market, and into the consumer asset-backed markets, which is how the credit markets, as you know, have matured to function? A, do you think we will get back to some version of that functionality for places where it's not functioning now? And if so, how long do you think it'll take to get there?
Well, I can't really opine on that. I am concerned that a downgrade across the board of an MBIA and an AMBAC would cause some kind of potential credit seizure of the markets. It's one of the things I did discuss with the banks that day, and I have discussed with a whole bunch of people over the last 6 weeks. I think that you definitely see some aspects of that now. I don't think that there is no role for the monolines in wrapping even securitized instruments, but we clearly crossed some line, and that's why we are, I believe, right now executing on our three-point plan. The three-point plan being to bring in more capital into this area, which we've done in various ways, to bring in fresh, unencumbered players, which is why we sought a Berkshire Hathaway and asked them for the offer on pricing the municipal side of the book. The second part of our plan is to potentially deal with distressed companies in this area, which we can talk about and why we held the meeting and what a good book and bad book plan would be. And thirdly, as you say, to begin to rewrite the rules of the road, begin to adjust how we regulate in this area, because somehow we crossed the line. I don't want to cast blame. The securities came to the companies as AAA rated. They merely put belt and suspenders on the super senior tranches here, but that still obviously wasn't accurate, or at least it's being questioned now, and we have to figure out how we can do that in a better way across the board.
Let me quickly get your thoughts on the Bill Ackman and the short sellers out there. Obviously, MBIA fighting back against Ackman's hedge fund, betting against MBIA. How instrumental have the short sellers been in terms of the meltdown of these companies?
Well, I really can't comment too much on that. I think actually it's been fairly instrumental. You do see that MBIA had to pay a lot more for money purportedly because of the actions of the short sellers. I do respect Mr. Ackman's acuity. I think the stuff that he writes and some of what he says is very insightful. However, Mr. Ackman does have to worry about speaking accurately in the marketplace, whether he holds a tremendous amount of short positions. He could be potentially a control person, and or there is a law under the insurance a law called 2604, which says you cannot, without a factual basis, disparage insurance companies. You have, because you can cause a run on the solvency. So I think Mr. Ackman performs an important function, but he should make sure that whatever he says is based in fact.
Yeah, Eric, a pleasure. Thank you very much for taking the time to talk to Maria and myself. We'll take a momentary break.